Hello, everyone. A huge warm welcome to all of you tuning in. We really want to thank you for coming to watch this and spending part of your day with us.
Absolutely. It's great to be here.
We know your time is valuable time is money, right? So we are going to make sure this is worth every second.
And we have a lot to get through today.
We certainly do. Today, we are opening up a file on a company that is, well, it's essentially a proxy for the entire global economy. If you want to know how the consumer is feeling in Ohio or Mumbai or Mexico City, you look at this company. We are breaking down the Coca-Cola company's fourth quarter 2025 earnings call.
And this wasn't just a standard, here are the numbers call, was it?
Not at all. Looking at our notes, this was a big one.
It was a pivotal moment. You had the changing of the guard at the very top, some really complex global headwinds, and a company trying to prove its strategy works.
Well, in any weather. That phrase, all-weather strategy, it came up a lot. It sounds great, but we need to see if the math actually backs it up. So let's kick things off with the headline news from their prepared remarks.
The leadership shakeup.
Exactly. James Quincey conducted his very last call as CEO.
That's right. Quincey's been at the helm since 2017. He's moving up to executive chairman and handing the CEO baton to Enrique Braun.
And looking back at Quincey's run, you called it transformative. That's a big word.
It is, but the numbers seem to back it up. You mentioned adding 12. Get this, $12 billion brands to the portfolio.
Wow.
They now have 32 brands that each bring in over $1 billion in sales. Just massive scale.
But what's the story behind that number?
Well, here's the key insight. 75% of those new billion-dollar brands, they aren't sodas. They're not sparkling soft drinks.
Ah, so that's the diversification play.
Exactly. It shows how Quincey shifted the company from just being Coke to being a total beverage company. You've got teas, coffees, dairy, sports drinks. He diversified the risk.
But they didn't take their eye off the main prize, did they? Because if the red can fails, everything else kind of fails with it.
No, they absolutely protected the core. Retail sales for trademark Coca-Cola, so the classic red can and zero sugar, grew by over $60 billion during his tenure.
So he managed to diversify without killing the golden goose.
Pretty much, yeah.
And financially, they hit a major milestone in 2025. They finally achieved $3 in comparable earnings per share, or EPS. Why is that number so significant?
It's a bit of a psychological barrier for Wall Street. For years, the company was sort of stuck around the $2 range.
Right.
Breaking through to $3, it signals that their efficiency measures, cutting costs, streamlining supply chains, are finally, dropping all the way to the bottom line.
Okay, so Quincey leaves on a high note. Now, enter Enrique Braun, the CEO-elect, and John Murphy, the CFO, to walk us through the actual 2025 performance.
Right. And for the full year, their organic revenue growth met targets. But here's the nuance. Unit case volume.
So the actual number of drinks they sold?
Exactly. That was flat for the full year.
Hold on, flat volume isn't great, is it? It means people aren't buying more, they're just paying more for it. Is that sustainable?
Well, that is the big question. Growth was driven by price and mix, but they did note that volume momentum improved month by month in Q4.
Okay, that's a better sign.
And importantly, they've gained value share for 19 consecutive quarters.
19? That's nearly 5 years of grabbing a bigger slice of the pie. So let's look at the map. Where's this growth coming from?
North America is the absolute star performer. It is carrying the team right now.
Really?
Oh, yeah. They grew volume, revenue, and operating income in the U.S.
Yeah.
It seems the U.S. consumer is still very thirsty.
For what, specifically?
Everything.
Yeah.
Trademark Coca-Cola, Sprite Zero, Fairlife Milk, Body Armor sports drinks. It was really broad-based success in their home market.
Okay, but if North America is the star, who's dragging down the average?
Asia Pacific was tough.
Yeah.
Revenue and profit actually declined there.
And the big issue is China.
Yeah. Consumer spending in China is really soft right now. Japan saw some growth, but it wasn't nearly enough to offset the declines elsewhere in the region.
What about Latin America?
A bit of a mixed bag, but mostly positive. They actually announced a new billion-dollar brand there, a dairy brand called Santa Clara.
A billion-dollar dairy brand in Latin America. That's impressive.
It is. But Latin America is facing some tax headwinds, which I'm sure we'll get into.
Okay, before we jump into the analyst questions, what are they promising for 2026?
They're projecting confidence. They've guided for 4 to 5% organic revenue growth.
And the big number for investors.
The EPS guidance. They're expecting earnings growth of 7 to 8%.
And that's on top of that record $3 from 2025. That seems fairly aggressive given the global economy.
It is. But they have a bit of a secret weapon this year.
Oh.
Currency. For the first time in ages, they are anticipating a currency tailwind.
So the exchange rates are finally working for them, not against them?
Exactly. They expect currency to actually boost their EPS by about 3%.
That's a nice bonus. And cash flow.
They expect to generate $12.2 billion in free cash flow. And, true to form, they're raising the dividend.
Of course.
For the 64th consecutive year.
64 years. That is the definition of a dividend king. Okay, so that was the company's pitch. Now let's move to the part where the analysts try to poke holes in that story.
The Q&A. This is where it gets interesting.
Let's go through them. First up was Dara Mohsenian from Morgan Stanley. He wanted to dig into that 4 to 5% sales growth outlook, right?
Yeah, he was asking about the balance between price charging more and volume selling more. He noticed Q4 volume was decent at plus 1%, but the pricing looked a little weird.
Right, so James Quincey took this one. And he clarified that while the Q4 pricing looked like it was only up 1%,
the underlying pricing was actually up 4%.
So why the gap? If prices are up 4%, why does the report say 1?
Negative mix. Basically, they sold more products in places or categories that have lower price points.
Okay, can you break that down?
Sure. Think of it this way. If you sell 1,000 Coke in the U.S. for $2 each, then you suddenly sell 1 million Cokes in a developing market for 50 cents each.
Your average price per case drops.
Exactly. Even though you sold way more soda overall, that's negative mix. So for 2026, Quincey said they're aiming for a balanced 50-50 split between price growth and volume growth.
Okay, next we had a question about the macro environment from Steve Powers at Deutsche Bank.
Right. James Quincey had previously called the global economy a light drizzle.
I love that phrase. So Steve asked basically, is it still drizzling or is a storm coming?
And Quincey stuck to his story. He said the light drizzle, that economic softness, it persists. It's not a recession, but it's not a boom.
But the expectation is that volume will pick up.
Yeah, in emerging markets like India and China as the year progresses. But he did mention Mexico is tricky because of a tax change. They'll feel that impact early, but they expect to mitigate it.
Okay, moving on to North America. Lauren Lieberman from Barclays zeroed in on profitability. The margins there hit 30%.
Which is huge for a grocery product.
So she asked, is this sustainable or just a one-off fluke?
And this is a crucial point. The CFO, John Murphy, stepped in here. He was very clear. It is not a fluke. He argued there has been a structural change.
What does that mean, structural change?
It means they've gotten much smarter. He said the company averages about 60 basis points of margin expansion per year globally. He called North America the star performer, crediting an efficient supply chain and marketing. Basically, they are running a tighter ship.
That's impressive for such a mature market. All right, next up, Chris Carey from Wells Fargo asked about those volatile markets, India, China, Mexico. What's the strategy?
And this is where Enrique Braun, the incoming CEO, highlighted that all-weather strategy. The core idea is diversification. You use momentum in strong markets, like the U.S., to offset the weaker ones.
Right. You don't need every engine firing at once.
Exactly. He was pretty honest about China. He said consumer sentiment is low, actually below pre-pandemic levels. But he pointed out that Coke is gaining market share there. So even if the pie is shrinking, they're eating more of it. He views China as a long-term build.
And India.
India had a rough year. Weather, taxes.
Yeah.
But he says they're investing ahead of the curve, building capacity now for demand they expect later.
Next, a question from Filippo Falorni at Citi on North America again. Fairlife, the World Cup, and the Hispanic consumer.
Enrique Braun took this. He confirmed Fairlife is a juggernaut. It's just continuing its momentum. But he also said something interesting about their sports drinks.
The dual strategy with Powerade and Body Armor.
Right. Having two competing brands can be messy. But he says it's working. They position them differently, and combined, they're gaining share and volume.
Okay, let's talk about money. Rob Odenstein from Evercore asked about that currency benefit. He noticed a weird discrepancy. A 1% benefit to revenue, but a 3% benefit to profit. Why?
This gets a little technical, but it's fascinating. John Murphy explained it comes down to hedging.
Okay, unpack hedging for us.
Think of it like buying insurance. They paid money to lock in the exchange rate for major currencies, like the euro and the yen. So they're safe from big swings there.
So where does the extra profit come from?
The extra profit, the tailwind, is coming from a weaker U.S. dollar against emerging market currencies, especially in Latin America and South Africa.
Ah, so the money they earn in those countries is worth more when they convert it back to dollars?
You got it. It's smart financial engineering. It lets the local teams just focus on selling soda.
Next up, Andrea Teixeira from JP Morgan asked about SNAP food stamps in the U.S. and the Mexican tax impact.
Quincey was pretty dismissive of the SNAP risk. He said the impact is manageable, a small number globally. His view is that consumers will shift their spending, and Coke just needs to have the right pack and price.
And the Mexico tax.
They admitted it's a headwind. But Braun emphasized the system is aligned. They plan to use revenue growth management, or RGM.
Which is corporate speak for changing package sizes and prices so you don't notice the tax as much.
Pretty much. Plus, Mexico is hosting the World Cup, and it's the Coke system's 100th anniversary there. Huge marketing hooks.
A pretty good distraction. Okay, next. Peter Delpo from Bank of America asked about an equity income headwind in the guidance.
This is an accounting thing. The headwind is because they sold their interest in Coca-Cola Consolidated back in November 2025.
That's a massive U.S. bottler.
Right. Since they sold it, they don't get the income from it anymore. So year over year, it looks like a drop, but it's just because that asset is gone.
Makes sense. Next, Peter Braun from UBS asked about cash flow. With $12 billion coming in, what are they going to do with it?
John Murphy laid out a very clear hierarchy. Priority 1, invest in the business. About 25% of that goes to bottlers they own in Africa and India, plus investments in things like Fairlife.
Priority 2,
the dividend. They're very protective of that 64-year growth trend. Priority 3 is flexibility.
Meaning?
Keeping cash for opportunistic M&A or share buybacks. But he specifically mentioned they want optionality in 2026, partly to manage the outcome of a pending IRS tax case.
The IRS case. Always good to have a rainy day fund for the tax man.
Exactly. They want to be ready to cut a check if they have to.
Next, Camille Gajrawala from Jefferies noted that the 7-8% EPS growth guidance seems like a slowdown if you strip out the currency benefit.
Yeah, he asked if they were being conservative or just spending too much.
And the response.
Murphy defended the guidance. He said the top-line guide reflects a sum of parts, some markets booming, others recovering. But he did admit there's a bias to invest ahead of the curve.
Meaning spending money now to make money later?
Yes. Investing in marketing, digital tools, all of it. He basically said, we aren't going to starve the business just to pump up the earnings number this year.
We also had a question from Charlie Hicks at Redburn about James Quincey's new role. Executive chairman can sometimes mean backseat driver.
Quincey was very clear. He said it's a transition role. Enrique Braun is the CEO. Enrique runs the company. Quincey's there to help with specific stakeholder issues and keep the board aligned.
And what did Enrique say about innovation?
He noted that Coke pruned its portfolio from 400 brands down to 170. They really cleaned house. Now, the focus is on a better success rate, finding the next billion-dollar brand by looking at what's working locally.
And finally, a fascinating question from Carlos Laboy at HSBC about India, specifically digital investments.
This was my favorite part of the call. Enrique Braun was so bullish on India, they are investing heavily in new production lines, but the digital stuff is wild.
Tell us about Coke, buddy.
So India has incredible digital infrastructure. Coke is using a platform called Coke Buddy that connects the bottlers directly to the retailers, the mom-and-pop shops.
Okay.
But it's not just an ordering app. They're using AI to determine the best SKUs, the specific drinks, for each individual retailer to carry.
Wait, what? So the app tells the shopkeeper, hey, in your specific neighborhood, people buy more Sprite Zero on Tuesdays, so stock that.
Exactly. It's the modernization of a century-old distribution model. It's all about efficiency in data.
That is the power of data right there. All right, that wraps the Q&A. Let's bring it all together. What are the main themes we should walk away with?
I think there are 4 key takeaways. First, a confident leadership transition. Quincey is handing a stable ship to Braun. No drama.
Boring, which is exactly what investors want. Second,
financial strength. Hitting that $3 EPS milestone was huge, and guiding for another 7-8% growth shows they believe the momentum is real.
And third has to be that all-weather strategy.
Absolutely. They're proving they aren't dependent on just one region. If China is down, North America is up. It's a balanced machine.
And finally,
the focus on innovation in digital. From Fairlife Milk to AI in India, they are using technology to drive the next decade of growth. This isn't just about sugar water anymore.
Well, there you have it. A deep look into the Coca-Cola Company as they head into 2026. A company in transition, but one that seems to know exactly where it's going. Thank you so much for watching.
It was a pleasure.
If you enjoyed this breakdown, please click like, share the video with your friends, and make sure to subscribe. We have some great deep dives coming up that you won't want to miss. Thanks for watching.